Welcome to the show Retirement Planning, Strategize and Secure, an interactive video workshop series presented by Outlook Money. Through this video series, we basically aim to arm you with all the information that you need for effective retirement planning. These workshops will be conducted by experts from various fields that can affect your retirement decisions like financial planning, aging, personal issues, health, senior living, among others. Today, we'll delve into your finances, and I'm glad to welcome Dilshad Billimoria, a SEBI-registered investment advisor, a prominent member of the Association of Registered Investment Advisors, or ARIA, and co-founder of Dilshad Consultants. She'll not only tell you how to calculate your retirement corpus, but also address the queries that you may have at the end of the session. We'll also have some fun polls in between the session. And before I hand over the screen to Dilshad, let's have the first poll for you today. You can click the option on your screen. Okay, so we end the poll now. And 25% have voted that they still kind of think that the children will be their retirement solution, and the other 75% say that basically they have a separate retirement corpus and they've already started investing in it. So at Outlook Money, we share the same, and we feel that planning for your own retirement is very, very important. And because families are becoming nuclear, life expectancy is increasing, lifestyles are changing. Children want to live separately than parents. And a lot of parents have this idea that they don't want to be a burden on their children. So if you have started planning already, which most of you seem so, it's great news. And now you'll get proper guidance from Dilshad to take this forward. So I now extend a very warm welcome to Dilshad Billimoria. Welcome, Dilshad, and it's now up to you to take it forward.
Thank you so much, Nidhi and the Outlook Group for giving me this opportunity. It's fantastic to kickstart the series on retirement planning, both at the accumulation and at the distribution phase. So what I'll be doing in today's webinar is I'll be taking you all through some very basic concepts on retirement planning, both at the accumulation and distribution stage. And I'll also be highlighting what are those other factors other than the number crunching that one needs to look at, and the experiences that we have faced with clients, asking on sometimes when you embark upon retirement, you realize that it's not the rosy picture or that specific date that you've always planned for. In fact, Mitch Anthony in his book, Retirement Planning, has stated that he's had clients with some of the worst experiences who've said that this is the start of retirement for them. So I'll be sharing a presentation, and Nidhi would coordinate and moderate the session. So thanks again, Nidhi, on the same.
Great, Dilshad. And before Dilshad starts sharing her screen, I would just request all of you, the audience here, that if you have any queries, please click on the Q&A tab and put in your queries there. Both Dilshad and I will be able to see it, and we'll address it as the session progresses.
Sorry, the presentation has just gone. Maybe you can just give me a minute.
So in the meanwhile, I would really like to have some of you writing in the Q&A tab, where we can really use it as an interaction tool for this workshop on why do you think it is important to save for your own retirement, since about 75-76% said that they will be they are investing for their own retirement. So Mr. Srinivas Rao is asking, how do we plan age-based retirement plan? There are a lot of things that Dilshad has in a kitty to kind of, maybe answer your questions already. And the presentation is on the screen now. So Dilshad, you can take over, please.
Great, thank you. So let me start with something very basic, right? Retirement in most, and we have seen in developed countries, there are typically people who have organized retirement schemes, like when you're working in India, also you have things like your EPF, your superannuation, your gratuity. But there is a very large audience who also belong to the sector where they don't get, planned retirement benefits from their company. So in such cases, they need to either build a corpus on their own or like Nidhi had asked, depend on your family members, which is not a very good thing, right? Because we've seen sometimes in the past how family and children react to old age parents as well. So the formal retirement planning guide typically would mean, benefits like your superannuation, gratuity, EPF. But if you don't have such organized programs, there are a host of investment options that you can plan. And the earlier you start, the better, right? So that's an important point. So I thought this is some of the mistakes that we have seen across, our clients when it comes to in the accumulation phase, not planning properly for retirement. Like, for example, choosing the wrong asset class, right? So we've got people who are so risk averse that sometimes, even though they are young, they do not want allocation to equity. So it's very important to choose the right asset class, to using the accumulated investments that you've built towards another goal. Now, this is a big no-no, right? So again, EPF, superannuation, these are things that have to be built towards the retirement corpus only. In fact, the good news is that many of our clients' retirement corpuses are actually fulfilled just by EPF and superannuation and gratuity, right? So it's important that we plan for a certain goal, we allocate resources for a certain goal, and do not compromise on using those, hard-earned money and those resources towards any other goal. And of course, starting a retirement planning late, right? So the earlier you start, you get the benefit of compounding, and compounding is like the eighth wonder of the world, right? So estimation of expenses. Now, this is, again, a very, very important misjudgment of expenses. And again, here we break it down into expenses that may not continue into retirement. Like, for example, if you're funding your children's education in your working years, typically by the time you start retirement, you should be free, or you should have built a corpus also to take care of their education requirements, which is independent of building the a retirement corpus. So make sure that you look at the retirement, and it's important to realize that the retirement goal is one of the longest. It's not like any other goal which will just last for a year. So if you're planning for your children's marriage, it's say 10 years from now, 5 years from now, 15 years from now, but it's on one specific year or date. If you're planning for education of your children, again, it's maybe spread over 3 to 5 years, depending on the course, etc. But it's again at a specific time. Retirement is the longest goal and therefore the highest uncertainty when it comes to planning, because it involves factors like uncertain inflation rates, uncertain interest rates, a host of instruments that may or may not beat inflation, that may not be tax efficient, right? So it is the trickiest of all goals.
Right. So before Dilshad, you talk about why one should not avoid equity. In fact, I want to know from the attendees, where do they invest for retirement? So let's have another poll on that. Please click on your screens. And if you think you, invest in multiple things, click on the one that you invest in the maximum. So we'll just wait for 30 seconds and then we'll end this poll. Yeah, and here are the results. So 43% invest in equity mutual funds. Primarily, 13% have taken to national pension system, which is also good news because it's a new instrument. Life insurance plans, 10% still, kind of invest in those for retirement. Fixed deposits, 11%. I'm sure Dilshad has a lot to talk about fixed deposit returns later in the series. And of course, like she mentioned, EPF, PPF, and other small saving schemes are instruments that a lot of people rely on. That is 22%. So that is something interesting. And now let's hear from Dilshad about your equity investments.
So actually, the good news from your poll is that 43% are looking at equity as a long-term savings plan for retirement, which is fantastic. And of course, wary of risk profiles and asset allocations also. But the not so good news that I'm seeing here is a lot in life insurance and fixed deposits, right? So unfortunately, there is sometimes people don't realize that, especially fixed deposits, and I have a slide on that as well, don't even cover inflation, right? So if you're getting like a 6% or a 5.5% or even a 7%, and inflation today is at 5.5%, your real return is between 1.5% to 2%. Post-tax, you might even earn a negative return on fixed deposits, right? So yes, it is guaranteed, it is fixed, but according to the Banking Regulation Act, up to 5 lakhs of one's deposit is only guaranteed by the bank, right? So it's not always the best instrument. And of course, life insurance plans also have, their disadvantages. So I'll leave Nidhi to look at that at another session. But this is a slide that was prepared on cost of avoiding equity as an asset class, right? So here there are 3 scenarios: equity, debt, and fixed deposit. And the rates of return are mentioned over here, and they're quite conservative. These are pre-tax returns. And say a person wants to build a corpus of 4.6 crores under each of these options. Now, by avoiding equity as an asset class, and say someone chooses fixed deposit, they might need to invest much more, assuming that all other parameters are the same. So a person aged 35 years of age who wants to retire at age 50 and needs to accumulate a corpus of 4.6 crores, and how that corpus is also created, I'll come to that. But with this is the bottom line. So with the return of just 7%, that person needs their money to work harder for them. And therefore, the savings required would be much more to reach that same corpus. So this is what is, the cost of delay of, and it could also mean the cost of delay and not investing in equity as an asset class, right? So this is an important takeaway. Now, like I mentioned earlier, retirement is very tricky because there are so many variables associated with it, right? We have, and this is just the number slide. You have other factors like legal and emotional and, family matters, etc. So, but when we take into consideration building a retirement corpus, you need to plan pre-retirement, post-retirement, right? So the pre-retirement or the accumulation phase also needs to ensure that your money works hard for you. And that's where the choice of asset classes, the rate of returns, how the portfolio is growing, is it meeting the corpus that you have planned for? Those are the checks that are required, right? And when you embark upon retirement, there's a completely different set of checklists that you would need to look at. How long will your corpus last? What are those instruments that will give you the most tax efficient return? See, for example, somebody who had invested in the late 90s, early 2000s, say in PPF itself, PPF was giving something like 12% rate of return in those days. No longer, and the PPF rates today at around 7.1%. So no longer that corpus would have sustained them till their life expectancy. With medical advances, we are seeing that people are living longer. In fact, it is proven that the life expectancy in India has gone up from 62 to 65 years of age. And actually, in reality, it is even higher, right? We are seeing people stay till 85, 90. So it's important that, when you're planning for your retirement, you're seeing whether the corpus lasts for you, and how long does it last for you and your spouse? if you're married, right? So you need to take care of your life. You need to take care of your spouse's life, and you need to look at the various risks associated with market volatility, taxation, market forces, and its impact on the returns on your portfolio, and the variability of the withdrawal that you're making. In fact, a very important consideration in all this calculation is what is that withdrawal rate that you must consider, right? Is it going to be 2%? Is it going to be 5%? Is it going to be 4%? So again, this is a scenario analysis that needs to be worked out properly. So these are some of the other factors, right? That when you plan for retirement, sometimes we've come across clients who would like to retire in their hometown. In a way, it's good because lifestyle, normally reduces, the expenses reduce. You live a healthier life, typically in your own hometown. You might not have the same stress levels that you had while living in your city, or, when the workload was very high. Another very important consideration is you might be, having loans on you when you're planning for retirement for yourself. So ideally, an important point to note is that all committed outflows stop at the start of your retirement, right? So it could mean your liabilities of your EMIs. It could mean funding for your children's education. It could mean, looking at various other factors that are committed expenses or outflows that may start at retirement. So it's important to make note of those expenses as well, and to realize, and again, to divide your retirement as early, mid, and late retirement, right? Because early retirement is typically when many people still continue working, but at a reduced kind of number of hours, or a reduced pay, or variable, flexible work times, etc. And that's fantastic, right? Because then you are not really dipping into your corpus, but at the same time, you might need a one-off large amount to go for a vacation, right? Or you might want to look at, starting your own venture post-retirement, right? So what is that kind of corpus that you need to build? What is the amount that you need to build? How do you tide over your expenses of taking care of family and building for that corpus? And a very important realization is loneliness. Okay. And this is what I was talking about when we just started, that sometimes people were used to a very, very, fast-paced life, pre-retirement, right? So these are questions that we have actually tried to bring in discussions, saying that what is it that you really want to do? What is your passion, and and build around that, right? So it's not as simple, like I said, of just building a corpus, but to plan upon various other factors, which might be legal, which might be social, which might be emotional, and of course, the number part of it as well. So Nidhi, maybe you can take a poll before I move to the next slide.
Yeah, absolutely. So there is one person, Lalit Wazirani, who's saying that there is no social security in India, so one has to fend for themselves. Of course, bang on. That is what we are talking about. That is what Dilshad is also explaining. And there are a lot of queries on whether the PPT will be shared. Unfortunately, it will not be shared. So I would suggest people to make notes. And before Dilshad goes forward with other very useful information, let's have another poll and kind of see that, what factors do you understand that, affect, what factors should you consider when planning for retirement? And I'm talking about the accumulation phase. So I'll let this poll run for another 10 seconds, 30 seconds we'll have to see what are the final results, and I'll share them on the screen. Yes. So we have the results here. So 12% say it's the choice of investment, rate of interest 5%, inflation rate 6%, considering your life expectancy, depending on what is the average for India and your family as well, that will make a lot of difference. That is 3%, and 75% say all of the above. In fact, I would also say all of the above and maybe some more. And Dilshad has talked about that and talk a bit more about that now.
So I think this is a very well-informed audience, and kudos to you all for that. I think all the factors are very, very important, and all keep, weighing importance in calculation and in, creating one's retirement corpus. And like I said, the factors that need to be considered pre-retirement are very different from the factors that need to be considered post-retirement. So pre-retirement, you're looking at accumulation, wealth creation, wealth growth, performing asset classes. And in the post-retirement phase, you're looking at wealth preservation. You're looking at longevity. You're looking at health care. You're looking at medical corpus creation. There is a difference, mind you, between healthcare and medical corpus creation. Then you're looking at, what are the factors of inflation? What are the factors of tax? What are the market forces and impact on your portfolio that you have built that would, kind of deplete or, reduce the corpus of your portfolio, right? So they're very different factors that need to be planned for. So this is something, like I said, if people have the accumulated benefits of these, most of the time your retirement goal is met. But like a listener had said, some of you do not have this, and that's absolutely fine, because I think these factors that are mentioned here on the screen are what you can work towards to build a healthy corpus while creating your retirement distribution phase, right? So this is like, how long will my savings last? Will it last for me and for my partner? What is my life expectancy, or are there family diseases that I need to incorporate? Do I have a health corpus? Do I have an emergency fund in place? Do I ensure that my real return on investment is going to ensure that my withdrawal rate takes care, and at the same time my corpus is not being eaten into? That's a very, very common question, right? So why do you think that sometimes investors want their money to be in an FD? Because they feel that, okay, my principal continues to grow and I am not touching the principal, I'm just drawing upon the interest. Well, the good news is there are investment options where you can ensure that your withdrawals are lower than the growth of your corpus. I'll be coming to that as well. And that's one of the most tax efficient ways that people have been able to sustain their investment plans for a longer period of time. Yeah. So I thought I'll run this, very simple retirement calculator. Let me see if I have that open somewhere here.
Okay. In the meanwhile, maybe we can run another poll, because, any retirement calculation, you really want to look at the age that you want to retire, and it might have a lot of effect on how you plan your corpus. So let's have the fourth poll today. On the screen is at what age do you plan to retire? And a lot of people clicking on 60 as expected, but we have 20 seconds more to go. Yeah, so a lot of them expecting to retire at 45 as well. So I'm ending the poll now. And let's have the results now. So, okay, only 50% want to retire at 60. The rest actually want to retire much earlier, some at 55, that is 25%. One-fourth of you want to retire at 55, 14% want to retire at 50, and just 11% want to retire really early, that is 45. And, young audience are with us, very heartening to see again. And Dilshad is out with her Excel to help you guys understand it.
So, I like the audience who have said 60 as their retirement age. And for those millennials out there, just take a 1 month break of your work and ask yourself, or even maybe 6 months, and you'd realize that, you need to do something, right? You need to keep yourself busy. You need to follow your passion. And of course, you can reach that level. And that's what I'm going to cover as well, which is called financial independence, right? So you need not retire so early. Believe me, it's not worth it. So here I've just got a very simple calculator, which I thought I could get answers live from the audience, but I'll share the calculation. So I've assumed an age of 30 years of any individual with a 60 years at start of retirement. And say your expenses today are 10 lakhs per annum, which is about 83,000 per month. Okay. The amount that you would need in the first year of retirement, and this is your annual expenses, is about 57 lakhs to maintain the same 10 lakhs per annum. And that translates to about 4,78,000 per month. Now, assuming your life expectancy is 80, you will need a whooping 10 crore 40 lakhs as a corpus available. And to meet this 10 crore 40 lakhs, you would need to invest 57,000 per month at a rate of return of 9%, such that you're able to achieve your goal 100%. Right? So, I could change the numbers here. I could say one is 25, and I could say your expenses are 5 lakhs. The important column that you need to look at are the last two, right? So what is that corpus that you would need, and what is the amount of saving? And I've assumed a very conservative investor at 9%. We can also calculate at 12%, 15%, 10%, but it's always better to be conservative in your approach while doing your estimates for your life goals, right? Especially retirement. So these are, and remember, if the markets today are giving you 20%, 25%, upwards, the party will not last. The lunch, there is no free lunch, and party will not last as long. Of course, we have the backings of a fundamentally strong economy, a good government, etc. But one needs to ensure that they plan effectively for their even the worst of times, right? And there are enough statistics to show when things fall and don't do well, they fall like a torpedo. Even worse than when it rises, right? So say, for example, 50 years of age you are today, and your expenses are 15 lakhs per annum, you would need, and you retire again. We've assumed that the retirement age is 60 in all cases. You can change the retirement age as well. You would need a corpus of 4.87 crores and an investment much higher because you're starting late. You're closer to the start date of your retirement, which is just 10 years away. And therefore your, monthly saving. And mind you, folks, these are monthly figures. So you need to save, when I say 2,50,000 per month, that's about 30 lakhs per year, right? So these are the amounts that you need to look at to save and plan for your retirement. And I've assumed, again, life expectancy at 80 years of age. Free to change that, free to, increase or decrease. Like I said, life expectancies are going up. So, importantly, another point that many people miss out is critical care and emergency fund while planning for retirement. Okay. And like I said, this is outside of your medical and health requirements. So it's very important that you understand that building a critical care corpus, especially if your family has a history, which is, of diseases, etc., and a medical corpus. So very importantly, expenses like, say, a cataract surgery or a knee surgery or a hip replacement are not covered by normal health insurance, right? So once you embark upon retirement, when your planner has calculated your expenses, you either build in these expenses into your calculation of future value of your, retirement corpus, or you create a separate corpus, which is called as healthcare corpus. which, would cater to these one-off expenses as well.
So Dilshad, I'll just come in for a moment. A viewer, Umesh Narvekar, is asking that the rate of inflation, what was the rate of inflation that you considered in the calculation?
6%.
6%. Yeah.
6% was the rate of
And there goes
inflation.
your answer. Yeah. Please continue.
Yeah. So this is what I was also saying. See, there are so many other implications like legal, health, emotional. A very, very important one is legal, right? So, for example, if you are at an age where, say, something, God forbid, were to happen suddenly to you and you're put on an artificial life maintenance kind of system, you need to ensure that your family members are aware of what needs to be done in that case. Say you cannot sign documents, or you cannot make investment choices, or you cannot take family decisions. I think those discussions, which are outside, again, of the numbers, are important to have with your family to say that, so will, of course, is one thing where you prepare if you are not there, right? So what would happen to your assets? How would they be distributed? Who would be the beneficiaries? Who would be the executor, et cetera, et cetera. But what happens when in life itself, unexpected events like an accident which makes somebody disabled, or you're on an artificial life support system, right? So how does your family take decisions in those circumstances? So that's a very important consideration as well. Right. So this is one of the important slides to consider while you are actually starting your retirement corpus distribution, right? So the first stage is to understand what are those various assets that you've accumulated over the period of time. And then you start building that, okay, from these assets, I need to ensure that the first 3 years are going to be in very safe instruments, which are not going to be impacted by market forces or volatility. Okay. Then what is the inflation that I need to consider, when I'm building the retirement distribution and retirement accumulation? So obviously, at retirement distribution stage, we try and take a lower inflation because, as we know, the Indian economy, inflation rates are reducing, right? Then what are those various strategies or options that you need to plan to build for your client post retirement, right? So it could even mean the senior citizen savings scheme. It could even mean, the pension scheme of the government, where they give you, you put in a lump sum corpus and they give you annuity for your life, and that takes care of your longevity risk. It could mean good investment options like mutual funds, which give you systematic withdrawals, which are tax efficient, right? Then we say that out of this, how do we bucket the various investments into different buckets so that we're able to draw upon each bucket without disturbing the rest of the corpus and without eating into the corpus, right? So that's again a strategy that you need to work on. And then, of course, you execute those recommendations. You build upon and review that every 6 months or once a year, right? And then you work on, what are those changes, or what are those course corrections? What are the macro factors that are impacting the portfolio that you've built? And therefore, what are those changes that you need to make to ensure that the sustainability of your corpus is there? So, folks, this is not a one-time exercise, right? So this has to be done on a regular basis, every 6 months, every 1 year, just to ensure that your money doesn't end fast, or your portfolio is still growing when you're drawing upon it, right? So there are so many considerations. And here we come to the scenario analysis part of it, right? So what are so when somebody, you got some answers, Nidhi, that somebody wants to retire at age 45. Now, the first thing that I would ask them is, how much have you built as your retirement kitty today? Okay. Are you ready to ensure that at least 60% or 70% of your earnings are done towards savings for retirement? Now, this could mean sometimes some absurd kind of lifestyle changes, right? And people really don't want that. You want to ensure that your lifestyle continues. You want to ensure that you build upon a corpus and are able to sustain it for a long period. So what I'm trying to say over here is that there is no rocket science to this, right? You either, postpone your retirement. If you want to advance your retirement to age 45, do you have those resources that are sufficient? And if you have those resources that are sufficient, are you saying that from age 45 till your life expectancy, which is 80 or 85, you have that much of a corpus that is going to sustain you and weather the market conditions, inflation rates, tax details? Of course, you will need the help of a financial advisor on this. But like I said, you either reduce your expenses, postpone your retirement date, or say that I'm not going to be, having such a flamboyant lifestyle as I have today, or I'm ready to invest more, right? So these are the 2-3 factors that you keep playing around with to decide and to arrive at typically when can you take that plunge into the start of retirement, right? So this is what I said. Financial independence is not only about stopping work. It's not about retirement, but it's doing something that you would love to do without having to, fall back on saying that I need to work for a certain income. I need to feed my family. I need to ensure that my loans are covered. I need to put my children through college, etc., right? So you can achieve, and this would be a better way of looking at saying retirement, because you can achieve financial independence by just managing your portfolio in an efficient way, right? So that is basically where you have the freedom to make choices, to make investment decisions, to make other decisions, and you're not dependent on that monthly paycheck. You are not dependent on that monthly paycheck, which is what is going to lead to the ability for you to take better investment choices. So passive income through rentals, or tax-free adjusted income through other investment options, right? So that is where you are trying to now optimally grow and create your retirement corpus. So I said I'll be coming upon the slide which talks about returns post tax and post inflation in which is the real return. So if somebody had invested in a fixed deposit and say the return was 6% and inflation is at 5%, your net return post tax, etc., is not even going to be 1%, right? So sometimes, like I said, the real return on any instrument is a decision factor for you to decide to invest in that instrument. And here are some other points to consider when you're taking an investment decision. Is my investment liquid? Okay, because you might get various fancy investment options and choices that at the end of the day is going to lock your money, and you don't have an exit, you don't have a way out. Is my investment choice inflation adjusted? Is it going to be tax efficient? And is it going to ensure that I'm able to sustain or take the advantage of moving from various markets? Because today only change is the constant, right? Nothing is constant. Everything keeps changing. And therefore, you must have that option of continually monitoring and making changes to your portfolio. So this is a very important strategy. People can write books on this. The bucket strategy, which typically advisors suggest to their clients when it comes to the retirement distribution stage, right? So typically your emergency requirements for the first 24 months are covered in a very safe investment, in liquid funds, or in arbitrage, or in bank quasi-FDs, etc., because you don't want any volatility. You may have built a corpus, but it has grown into other asset classes of, alternatives, equity, real estate, etc. So you need to start consolidating and moving things into liquid assets. So the next bucket is where you take care of the first 3 years of your expenses, right? So what are those typical investment strategies? So now, this is not a hard and fast rule, okay? I could possibly move, hybrid to bucket 3 and keep only bucket 1 for arbitrage. Again, it's dependent on what are those expenses, what is that accumulated corpus, etc. So there is no rule book here. It's just kind of a reference guide. The next, bucket is typically between the 37th to the 72nd month, where you take care of the longer tenure instruments, maybe your senior citizen bonds, debt mutual fund, some amount in longer FDs, or even in government security bonds, which are, giving you either tax-free or long return, fixed income returns on that. Then we move into the longer tenure, which is again dynamic asset allocation or hybrid. And then we move into the last bucket, which is after the 10 years into equity. Now, again, in equity, you have so many categories, right? You have large cap, mid cap, sectoral, flexi cap, multi cap, and it goes, and the list goes on, right? But like I said, these investment options are not a rule book, right? It's just a reference guide for you to realize that, okay, ideally, typically longer is my holding period, and therefore I would put more money into equity, which is a no-brainer there. So this was, a strategy that we had built where we said that suppose today you have a 1 crore corpus. Okay, and we are trying to compare here the difference between SWP, which is your systematic withdrawal plan, and the dividend payout option. And in the systematic withdrawal plan, we are trying to show that, what you draw upon, you are paying tax only on a certain component of that amount, and therefore you get 2 benefits right away. Your tax on that withdrawn amount is much lower because you're paying tax only on the gains. And 2, your remaining corpus is continuously growing for you. And that will take care of the longevity risk. Now, if somebody were to say, no, I want the dividend option of a mutual fund, and both these are mutual fund kind of analysis, 2 big disadvantages are dividends are taxable, and this was started 2 budgets ago, and the dividend amounts may not be constant. And a third, which I have not written here, is whenever a dividend is paid to you, the corpus reduces to the extent of the dividend that is paid. So effectively, what if the withdrawal that you're getting in terms of a dividend and the balance corpus that you have left, you're actually going to eat upon that corpus, which I've shown here in red, right? So you don't want that situation to happen. You don't want to eat upon, your principal, but you want a strategy that is going to ensure that you get a good amount, a healthy amount. And here I've done a comparison on both cases, where your returns are going to be good in the withdrawal part, as well as the corpus at the end of the period is going to be more than your invested amount, right? And that's what you try and aim for at all points, right? So this is the SWP versus one of the most frequent talked about, and sometimes the numbers are not understood. So I thought, let me just share an illustration on that. So here is an interesting slide. And let's tie it back to the question which Nidhi asked, about when do you want to retire? And this is statistics that is proven from Investopedia. So if you see, you have the millennials, you have the Gen X, you have the baby boomers, and you have the Gen Z category, and their ages are here, right? So everyone, luckily, except for the Gen Z, which is the youngest between 18 to 25 years of age today, want to retire in their 60s. Okay. And again, here it's a lifestyle choice, or it's like the options, etc. Whatever may be the rationale or the reasoning behind Gen Z. And again, there's no hard and fast rule. It's just kind of illustration, and of course, backed by research about when typically people want to retire. And this is an assumption of, therefore, how should you be building your corpus so that you're able to take care of this a period where, and remember, obviously, the later that you retire, the period in retirement is shorter, and therefore the uncertainty also reduces. It's not left, I mean, it's not lost, but it's reducing, right? So this is just a kind of data point. So these are typically questions that, investors ask, do I have enough when I retire? Like I said, what if I am incapacitated in my life? Does my spouse, is my spouse's life also covered in my absence? Okay. What if my spouse predeceases me? Will healthcare take care of, or will the corpus that you have created but take care of healthcare and vacation and other recurring things, like, say, I want to repair my house every 5 years. I need to, build upon those things as well when I'm creating that corpus, right? So these are typically the normal questions, but it's important to be aware of these questions.
So that brings me to some of the questions that our attendees are
Sure.
asking today, the viewers. A lot of them are asking questions about taxes, national pension system, health insurance. I assure you, this is a video workshop series, and we are going to address all of these issues separately. So for that, I'll request all of you to tune in as we come up with different topics and address different issues. But among focused questions, one of the, Dilshad, you have spoken so much about equity and the importance to invest in equity, especially when you are younger. So somebody is asking, with markets the way they are now, is it a good time to invest in mutual funds and stocks? That's Arkal Good Seshadri asking.
Yeah. So definitely mutual funds. I would think the kind of investment categories are all covered in mutual funds. And I would also say that, look, when the market is doing so well, sometimes investors want to enter into equity and stocks directly without understanding the implications of when there is a downside risk. Right? So that is something that you need to be very cognizant about. So build upon a corpus of at least 50 lakhs to a crore in mutual funds. And then I would say, enter into direct equities, because remember, in mutual funds, you're getting the same theme, you're getting the same objective, better strategies, and you have a portfolio of diversification, which automatically reduces your risk, right? Whereas in stocks, you are just buying that one stock and hoping for it to do well.
So again, a lot of real estate questions, and some of you who are raising hands, I would request you to go to the Q&A tab at the bottom and post your queries there. We won't be able to take a lot of queries, so I'll take two more. There is Paneer Selvam, who has a very genuine query saying that, what about those earning between 50 to 60,000 per month? And if they are in their 40s, how do they go about retirement planning?
There's nothing different for them. All they have to do is identify what are their expenses, and when would they like to retire. Have a look at their existing accumulated investments. If they don't have one, I think don't wait any longer. Please start right away. And have that grown by a financial advisor, so that you're able to draw upon that for retirement. So this is for anybody and everybody, right? Again, a myth is that I need to be rich to plan for my retirement. That's a myth, right? That's a myth, because if I have whatever I have, and if I work with it in the right manner, I think I can achieve that to the extent that is within my lifestyle and within my life expectations.
So we are taking the last question now by Sanjay. If someone has 8 years to retire, which type of mutual fund investment should be done? Can we invest in mid cap and small cap?
I would say, again, it's too broad a question to answer. Look at your risk profile, look at your asset allocation, look at existing kind of investments that you've accumulated, because that's going to be a decision maker to say that, okay, I've already got allocation, say, to large cap or mid cap, and therefore I need to look at other. But if anything more than 5 to 7 years, equity is definitely an asset class that you should be looking at today, assuming that markets are continue to grow in the next 5 years, which I hope they will.
We now come to the end of the session, and apologies for those questions which were not answered, but a lot of them were on different topics, which we will kind of address in this video workshop series as we go forward. And many sincere thanks to Dilshad for taking out time for conducting this very informative workshop. In fact, you've got a compliment from a few attendees that the workshop was very good. And as for the questions of again whether the PPT will be shared, well, we will not be able to share the PPT, but of course this session will be put on social media on our YouTube handle. So watch out for that and stay tuned for future episodes. And at the end, I would also like to add that retirement is an important conversation for Outlook Money. And in fact, our retirement planning expo that was held in Bombay and which was a success is now being brought to Delhi in October. So I would really, request those from Delhi to come and attend. And ARIA, of which Dilshad is a member, is our knowledge partner there. They will associate with us. So there'll be a lot of conversations, activities, experiences to immerse in, and get your piece of advice at the expo. So stay tuned for information on other aspects that can affect your retirement. Thanks a lot for attending.